This is February 1st, 2026. Silver just hit $120 per ounce, $120, a barrier that was unthinkable just 12 months ago when silver was trading at $30, a 300% gain in a single year, the fastest, most violent rally in modern commodity history. And then, in less than 48 hours, it crashed to $84, 40% wiped out, billions of dollars evaporated, retail investors liquidated, margin calls executed across the globe. And if you're watching this right now, if you're holding silver or thinking about buying silver, you need to understand exactly what just happened. Because the question everyone is asking is not whether silver can recover. The question is whether $200 is next. And by the end of this video, you will have the answer. If you're new here, I analyze the structural forces driving commodity markets, while everyone else is distracted by price action and headlines. Subscribe right now because what I'm about to show you is a comprehensive roadmap of where silver is going in 2026, backed by supply data, institutional forecasts, and technical analysis that you will not find anywhere else. And if this video helps you understand the silver market, smash that like button so the algorithm shows this to more people who need to see it. Now, let me tell you what happened. Silver broke the $50 resistance level in early January 2026. That was the first major psychological barrier. $50, a level that hadn't been breached since January 1980, 46 years. And once that barrier fell, the market went parabolic, $70, $90, $100. And then, on January 29th, silver hit an intraday peak of $121.60, the highest price in recorded history, a 200% return in a single calendar year. Institutions were projecting higher. Robert Kiyosaki called for $200. Citigroup published targets ranging from $110 to $150. Goldman Sachs estimated $85 to $100. Metals, Focus, a respected research firm, gave a range of $60 to $175, acknowledging that the market had entered price discovery territory where historical models no longer applied. But then came February 1st, Blood Friday, the crash. Silver plunged from $121 to $84 in less than 2 days, a 30% collapse. So what caused the crash? Two events, simultaneous, coordinated, devastating. The first was the nomination of Kevin Warsh as the next Federal Reserve Chairman. Warsh is a monetary policy hawk. He represents the end of easy money, the end of debasement. The market immediately repriced the entire precious metals complex. The US dollar index surged back above 97. And when the dollar strengthens, commodities priced in dollars get crushed. Gold fell 29%, silver fell harder. This is the Warsh shock, the repricing of the debasement trade. The second event was even more brutal. The CME Group, the exchange where silver futures are traded, implemented a massive hike in margin requirements. Effective February 2nd, maintenance margins were raised from 11% to 15%, and for high-risk accounts, up to 16.5%. This is a margin trap. When margins are raised, leverage traders are forced to post more collateral immediately or liquidate their positions. And when everyone is forced to sell at the same time, the price collapses vertically. Every man and his dog rushed for the exit. There were no buyers, only sellers. The market fell into a liquidity vacuum. This wasn't a natural correction. It was a forced liquidation event engineered by exchange rules to prevent a systemic clearinghouse failure. Now here's what you need to understand. The crash was not caused by a change in fundamentals. Industrial demand did not disappear. The supply deficit did not reverse. The physical shortage did not resolve. What crashed was the paper market, the leveraged futures, the speculative positions. But the underlying structural reality that drove silver to $120 in the first place, that is still intact. And that is why $200 is not just possible. It's probable. Let me show you the fundamentals. Silver has been in a structural supply deficit since 2021, 5 consecutive years. In 2025 alone, the market deficit was approximately 149 million ounces. Cumulative deficits from 2021 to 2025 have reached nearly 820 million ounces. 820 million ounces. That is not a temporary imbalance. That is a systemic shortage. The world's visible buffer stocks have been drained, and the market is now operating on fumes. Why can't supply increase? Because 72% of silver is produced as a byproduct of other metals: lead, zinc, copper, gold. Silver is not mined on its own in most cases. It comes as a secondary output when companies mine for primary metals. This means that even when silver prices hit $120, supply cannot respond quickly. Production levels are dictated by the economics of the primary metal, not silver. This is the byproduct trap. And it's why the structural deficit will persist through at least 2027, regardless of short-term price volatility. Now, let me show you the demand side. Industrial fabrication now accounts for roughly 55% to 59% of total global silver demand. And three sectors are driving this demand to unprecedented levels: photovoltaics, electric vehicles, and artificial intelligence infrastructure. The solar sector alone is consuming over 200 million ounces annually as of 2026. In the United States, solar capacity is projected to grow by 70 gigawatts through 2027, requiring an estimated 143 million additional ounces of silver. The European Union's 2026 mandate for solar energy integration in new buildings, combined with massive solar farm construction in Saudi Arabia and China, has created a baseline of demand that is relatively price insensitive. Electric vehicles have doubled the silver intensity of the automotive sector. A traditional internal combustion engine vehicle contains approximately 15 to 25 grams of silver. A modern EV requires up to 50 grams. Global EV sales rose 21% in 2025. Gartner predicts that EVs on the road will increase by 30% in 2026, reaching 116 million vehicles. That is a massive structural demand increase that cannot be reversed by short-term price volatility. And then there's AI. The build-out of AI data centers has introduced a new and aggressive demand vector: high-efficiency electrical components, precision contacts, thermal management systems. All of these rely on silver's superior conductivity. Furthermore, the indirect demand for silver generated by the energy needs of AI, specifically the construction of new nuclear reactors, each requiring approximately 56,000 ounces of silver, has created a synergistic demand loop. This is not speculative demand. This is industrial necessity. Now let me show you what happened to physical inventories. In mid-January 2026, institutional investors initiated what has been described as a physical run on exchange-held inventories. Between early and mid-January, approximately 33.45 million ounces of silver, representing 26% of COMEX's registered inventory, were physically withdrawn for delivery. Total COMEX inventory dropped 22% from its September 2025 peak, reaching 415 million ounces, the lowest level since early 2025. Registered inventories, the metal specifically available for contract fulfillment, collapsed by 34.3%, from 134 million ounces to 88 million ounces. This triggered an intense short squeeze. Short sellers found themselves unable to source physical metal to close their positions. They were forced to pay escalating premiums, driving prices vertically toward $120. And here's the critical data point. 1 month lease rates spiked from 1.2% to 8%. 8%. That is an acute liquidity crisis. And that is proof that the paper game was collapsing. When lease rates spike like that, it means physical silver is so scarce that holders are demanding massive premiums just to temporarily lend it out. London vaults also saw massive drawdowns. LBMA stocks fell from 890 million ounces to 712 million ounces, a 20% decline. This is a global phenomenon, not isolated to COMEX. The entire physical silver market is under stress, and the February crash did not resolve this. Physical demand remains robust. Industrial buyers still need the metal. Central banks in Asia are still diversifying into silver. Retail investors in Hong Kong and southern China are viewing silver as a cheaper alternative to record expensive gold. Retail shops are selling out of silver bars within hours. Now let me address the institutional forecasts, because this is where it gets interesting. There is no consensus. Robert Kiyosaki is calling for $200, driven by hyperinflation and tech consumption. Citigroup is projecting $110 to $150, citing acute physical shortages and momentum. Goldman Sachs is more conservative at $85 to $100, focusing on green transition demand. Metals Focus has a massive range of $60 to $175, acknowledging that the market is in uncharted territory. UBS is targeting $95. Commerzbank is at $80 to $85. JP Morgan, always the contrarian, is calling for mean reversion to $58. And TD Securities is projecting an average of $44.25, assuming tariff de-escalation and a normalization of speculative excess. The lack of consensus among Tier 1 institutions highlights the fact that silver has entered price discovery territory where historical models have failed. This is not a market trading on fundamentals anymore. This is a market trading on fear, momentum, and structural shortage. And in that environment, anything is possible. Now let me show you the technical roadmap. Despite the February crash, veteran technical analysts argue that the long-term bullish structure remains intact, provided the $70 to $78 zone holds as support. This region aligns with a 50-day exponential moving average, which has served as a historical demand floor during secular bull markets. The roadmap to $200 depends heavily on what analysts are calling the May surge thesis. According to this model, February and March will serve as a consolidation period. A healthy shakeout that removes leveraged speculators and allows physical inventories to stabilize after the margin-driven panic. If silver maintains its support above the 50-day EMA through February, technical extensions suggest a secondary parabolic advance targeting $200 by May 2026. And here's the mathematical logic. The gold to silver ratio. Historically, this ratio averages between 40 and 60. During the early 2020s, it spiked toward 80 to 100. But as of early 2026, the ratio has begun a secular downtrend, breaking below its lower boundary for only the fourth time since 1970. If gold stabilizes near $5,000 per ounce, as projected by several major banks for late 2026, and the gold to silver ratio compresses to its historical supercycle level of 25 to 1, the implied price of silver would be $200. 5,000 divided by 25 equals 200. This is not speculation. This is mathematical reversion to historical norms. Silver does not need to rally in isolation. It merely needs to regress toward its historical valuation relative to gold, and that process has already begun. The crash in February does not invalidate this thesis. It's a temporary deviation caused by forced liquidation in the paper market. The physical market is telling a completely different story. Now let me address the risks. Because no analysis is complete without acknowledging what could go wrong. The first risk is technological substitution. Sustained prices above $100 per ounce may accelerate research and development into copper or aluminum-based alternatives for solar panels and electronics. If the thrifting of silver content accelerates faster than capacity growth, the industrial deficit could narrow. The second risk is monetary normalization. If the Warsh-led Federal Reserve successfully stabilizes inflation and raises real yields above 2%, the opportunity cost of holding non-yielding silver will increase, leading to sustained institutional liquidation. The third risk is recessionary feedback. A global economic downturn, potentially triggered by the very tariffs that fueled the initial silver rally, would suppress industrial demand in construction and automotive sectors, removing the growth component of silver's valuation. But here's why I believe these risks are manageable. Technological substitution takes years to implement at scale. Monetary normalization in the face of $38 trillion in U.S. debt and $970 billion in annual interest costs is mathematically impossible. And recessionary demand destruction would be offset by safe haven buying as investors flee financial assets. The structural deficit is real, the physical shortage is real, and the path of least resistance remains higher. Now let me tell you what you should do. If you are holding physical silver, do not panic. The February crash was a liquidation of leveraged paper positions. Your metal did not disappear. The fundamentals that drove silver to $120 are still intact. The 5-year deficit, the collapsing exchange inventories, the inelastic mine supply. All of this supports higher prices over the medium term. Hold your metal. Do not let short-term volatility shake you out. If you are holding paper silver, ETFs, futures contracts, understand the risks. The margin hikes prove that leveraged positions can be forcibly liquidated regardless of fundamentals. If you want exposure to silver, consider rotating into physical or into vehicles like the Sprott Physical Silver Trust that offer allocated storage. Paper promises are not the same as metal in hand, and the February crash proved that. If you are looking to buy, the current consolidation may be your opportunity. Now let me give you the timeline. If the May surge thesis is correct, silver will consolidate through February and March. It will test the 50-day EMA multiple times. It will shake out weak hands. And then, in late March or April, it will begin the second parabolic leg. By May 2026, the target is $200. That gives silver 3 to 4 months to double from current levels. Is that realistic? Absolutely. Silver went from $30 to $120 in 12 months. A move from $80 to $200 in 4 months is entirely within the historical volatility range of this metal during supercycles. This is February 2026. Silver just hit 120. Then it crashed to 84. The paper market liquidated. The physical market remains tight. The structural deficit persists. Industrial demand is inelastic. Central banks are accumulating. Retail investors are buying physical. And the gold to silver ratio is compressing toward historical norms. The roadmap to $200 is clear. The timeline is May 2026, and the only question is whether you will be positioned when it happens. Subscribe if you haven't already. I will continue to track the silver market as this consolidation unfolds. Drop a comment and tell me if you think $200 or $100 is realistic, or if you think the top is in. Are you holding physical or paper? Are you buying this dip or waiting for lower prices? I read every single comment. Hit the notification bell so you don't miss the next update when silver makes its move. Share this video with anyone who needs to understand what's really happening in the silver market. Silver hit $120. It crashed to 84 per ounce. The fundamentals didn't change. The deficit is real, the shortage is real, and $200 is not a dream. It's a mathematical inevitability driven by supply, demand, and the compression of the gold to silver ratio. The May surge is coming. The question is whether you'll be ready.